Looking for higher yield and safer investments in 2023? I don't blame you, considering we just saw a brutal year in the stock market. Actually, stocks saw their worst performance since 2008, and we remember what happened shortly after that, a great recession. Many economists right now are predicting that we are going to fall into a recession here in the first half of 2023, assuming we are not already in one. As such, let's focus on some high-yield dividend stocks today. Stocks that are going to pay you a high yield, but also hold up in a recession. If that sounds great to you, smash that like button down below, and let's get started. Hey everyone, Mark Rouston here, back for another video. If you're new to the channel, welcome. Here we talk about dividend stocks and building passive income over the long term. Make sure you subscribe to the channel so you are notified anytime we drop a new video. One of the reasons I love dividend stocks, especially blue chip dividend stocks, high quality is what we really focus on. Whether the stock goes up or the stock goes down, we can count on that dividend income each and every year. And as you build up more dividends, you can reinvest those back into those same companies or different companies, compounding your wealth over time. As such, in today's video, we are going to look at 3 high-yield dividend stocks that can get you some higher dividend income in the year ahead. But before we do, here's a quick word from today's sponsor. Today's video is sponsored by MooMoo. MooMoo is a commission-free trading platform available here in the States, as well as Singapore and Australia. The company continues to have a great holiday sweepstakes offer through January 15th worth a total of $60,000. They have a top prize valued at $50,000 cash and 10 second place prizes valued at $1,000 cash each. In addition, if you sign up with MooMoo using my link down in the description below, you could get yourself up to 15 free stocks to help you get started. MooMoo has a ton of great tools for investors of all types. If you're brand new to investing, they have paper trading where you can practice investing in stocks or trading stocks. They also have stock screeners, heat maps, and institutional tracking where you can follow the likes of Warren Buffett and see some of his top holdings in his portfolio. Definitely take advantage of this special offer. Link is down in the description below. With that being said, let's take a look at our first high-yielding dividend stock, which is Altria Group, stock ticker MO. Altria Group has long been a staple of many dividend portfolios for many years, but since mid-2019, the stock has been trading in a range of $40 to $55 for much of these past 3.5 years. The company currently has a market cap of $82 billion. Shares of Altria provide investors a high yield of 8.2%. The company has increased their dividend for over 50 years, making them also a dividend king. Not only does the company offer a high dividend yield, but they're also trading at a very compelling valuation. Before we look at valuation, let's first look at how the stock has performed over the past year. Shares are pretty much flat on the year, far outperforming the S&P 500, and from a total return perspective, shareholders have enjoyed nearly 5% returns, which is nothing to write home about, but considering the S&P 500 just lost 20% in value over the past year, I'm sure many investors out there will take a 5% return. Now let's have a look at valuation. Shares of Altria currently trade at just 9 times next year's earnings. Over the past 5 years, shares have traded closer to 11.5 times. Growth has definitely slowed for the company, but when it comes to high-yield, mature dividend stocks, it is less about revenues and more about cash flows. Over the past 5 years, Altria has been able to generate a free cash flow CAGR of more than 8%, allowing the company to not only pay a high dividend yield, but to continue to grow that dividend as they have increased it for more than 50 consecutive years now. The negative with Altria has been a lot of failed acquisitions in recent years, with Juul and Kronos Group both being disasters. But a more recent investment is the venture they're doing with JT Group, which is focused on heated tobacco products. This has the potential to reignite some growth back into the business. In a time when the US is expected to enter a recession, Altria Group trades at a very compelling valuation with a high dividend yield. The second high dividend yield stock on our list today is Verizon Communications, stock ticker VZ. The telecommunications sector has seen tons of competition just in the past few years alone, from the likes of Verizon battling it out with AT&T, who's battling it out with T-Mobile. Verizon Communications currently has a market cap of $165 billion. T-Mobile is actually the competitor that has been growing the fastest, taking market share from both Verizon and T-Mobile. But they're not a dividend stock, so they are not considered for this video. AT&T, on the other hand, has had a ton of issues. They have failed acquisition after failed acquisition, which has brought on mountains of debt for the company, and they actually had to spin off part of their business to help with that debt payoff. That leaves us with Verizon, and over the past year, shares are down over 20%, putting them roughly in line with the greater S&P 500. Closing out the year, though, when the broader S&P 500 had limped into the close, falling 4%, Verizon shares actually stood tall and climbed over 6% to close the period, as investors continue to reposition their portfolios more to defensive names like Verizon. Again, assuming that we are headed towards a recession in 2023, Verizon looks like a great, compelling buy at these current levels. And we're going to look at valuation here in a second. But in terms of the overall fundamentals and the balance sheet of the company, Verizon has a triple B+ rated credit rating. I fully expect Verizon to hold up in any economic downturn. In addition, the stock offers a very generous dividend yield at 6.7%, the highest on our list today. Over the past 5 years, Verizon shares have had an average dividend yield of 4.6%. So that kind of tells you a little bit about where we have been and how the stock has fallen so far that the yield is up near 7% now. Although the yield is high, the company still maintains a safe payout ratio less than 50%. The company has also increased their dividend for 18 consecutive years now. Free cash flow continues to remain robust as the company is expected to end 2022 with $20 billion in free cash flow. This will continue to support this high yield dividend. Looking at valuation, Verizon shares trade at just 7.9 times next year's earnings, compared to a historical average of 11.6 times. The third high yield dividend stock on our list today is Crown Castle, stock ticker CCI. CCI hails from the REIT sector, one of my favorite sectors out there today. They are actually a cell tower REIT, one of the largest in the world. Crown Castle has a market cap of $58 billion, making them the second largest cell tower REIT behind the likes of American Tower, who has a market cap of $98 billion. In 2022, shares of CCI lost roughly 30% of their value. The business model for CCI is pretty simple. They build the infrastructure for these telecommunication giants. So we are piggybacking off the likes of Verizon, which we just spoke about. Crown Castle has a portfolio that consists of more than 40,000 cell towers, approximately 115,000 on air or under contract small cell nodes, and approximately 85,000 route miles of fiber, giving them a presence in every major U.S. market. Growth drivers for the company continue to be higher mobile data usage. Everywhere you go, you see folks on their phones. Also, the continued rollout of 5G, which is the fastest on the market, but the problem is the data cannot travel as far as 4G, so there is a larger need for more cell towers. With cell towers, similar to how I've discussed with American Tower, they can have multiple tenants. So they can build a cell tower, lease it out to the likes of Verizon, which we just spoke about, but there's other areas to make higher margin. They can also put the likes of AT&T and T-Mobile on there, having a 3 occupancy cell tower, which blows up the gross margins for that company. The company has strong fundamentals backed by strong growth drivers moving forward. We already talked about the data and the growth in data, as well as the mobile usage, the 5G rollout, long-term leases, and renewal rates near 100%. Altogether, this supports a nice high yield of 4.6%. The company has also been growing the dividend at a nice clip of nearly 9% per year over the past 5 years, and they have increased that dividend for 8 consecutive years and counting. In terms of valuation, again with REITs, we want to look at FFO or AFFO, which is funds from operation. Think of this like operating cash flow. We do not look at EPS because real estate adds loads of depreciation and amortization expense, which are accounting rules and are non-cash charges. So in terms of AFFO, CCI is expected to generate $7.63 in 2023, which equates to a forward AFFO multiple of 17.7 times, compared to a 5-year average of 22.8 times, trading well below their historical average. All 3 of these options pay very solid dividends. You have Altria and Verizon, which are our 2 largest high-yield dividend stocks that we talked about today, but then you have a REIT in Crown Castle, which is a cell tower REIT, has a lot of growth behind it, growing and increasing that dividend at a much faster clip than the other two and a little bit lower dividend yield. In the comments section down below, let me know which of these 3 high yield dividend stocks that you prefer here in 2023. And with that being said, I hope you enjoyed the video. Make sure you hit that like button down below and we'll see you next time. Take care.